Hello and welcome to The Upside. I'm your host, Emily Ananuevo. Dividend investing has long been a cornerstone for investors seeking income and resilience, a consistent safe stream of returns, providing a cushion in one's portfolio while reducing overall risk. But how does a dividend strategy stack up in today's evolving market as geopolitical tensions rise and overall inflation continues to impact investors? To help answer these questions and more is portfolio manager Don Newman. Don will share how dividends can play a role in building more resilient portfolios and ultimately how investors can benefit from a dividend strategy. Don, welcome to the show. Thanks for being here.
Pleased to be here, Emily.
So Don, you manage many portfolios on behalf of investors, including Dividend Plus Fund and Dividend Fund. Now, for investors who are first starting out in their investment journey, Don, if you can explain what dividends are, how they work, and why they matter.
Okay. Very simply, dividends are just distributions that come from companies and so it's sort of a proportion of their earnings. So a lot of companies will think about it as sort of a fixed percentage of earnings. Maybe they pay out 30, 40% of their earnings every year. And it's a really great way to sort of reward shareholders for holding their stock. Why kind of dividends make sense and why the strategy is good for sort of investors over time. It's a wonderful combination of both income and capital appreciation. Stocks should go over time, but you're actually receiving income. And the great thing about dividend income is it's not like a bond where you're receiving the same payment every year. Assuming companies are growing, and they should over time, and if they're good companies and we're putting the right stocks in the portfolio, that income stream actually grows and is a wonderful way to sort of fight off inflation and beat inflation. So for an example, if your company is growing earnings 8% a year, and it has a reasonable payout ratio, your earnings that dividend stream should probably grow 8% a year. And that's going to well beat inflation. Number two, think about volatility. The companies have been around a long time. A lot of them are pretty stable. Balance sheets are in good shape. They tend to be a little bit less volatile than the overall market. It's also a great way stocks over the long term go up. There are periods, months, sometimes it can be years, where stocks are a little bit volatile. It's a great way to sort of earn income kind of while you wait. Over a long period of time, you're going to make money on the capital appreciation, but why not be bringing in income while you're waiting for that to happen? It's just a sort of nice feeling to see that income come in, and generally dividends are paid quarterly. And the last reason is just actually, if you're a Canadian investor, dividends are actually tax advantaged. So you often have a lower tax rate on dividends than you do on your ordinary income.
Excellent overview there, Don. Now let's dive deeper into a little bit more into your strategy behind the funds. Now
Sure.
You've said that you place high value on the quality of a company, its ability to generate free cash flow, and the strength of a balance sheet, like you mentioned. What else are you looking for when it comes to companies?
Yeah. So what I'm trying to do with the strategy is basically what a lot of managers should be trying to do is outperform the market over time. So we're working with our analysts here, and we have analysts on every sector basically across the world. It's a wonderful global organization Fidelity has put together. But part of my strategy is that sort of comes second is the idea of doing it with a little bit lower volatility.
Okay.
And so what we've found over time is investors get very excited at the top and always want to buy when things are the best, which may not be the best time to buy. And they get very sort of nervous and almost scared at the bottom and have a tendency when volatility picks up and stocks go down a fair bit to go, I don't want to do this anymore. And that's really the wrong decision. They tend to sort of buy at the wrong times and sell at the wrong times. What I'm trying to do is put together a quality, like good companies at reasonable prices that can maintain and grow their dividends over time, where we're getting a good yield and getting good earnings growth so that sort of in the dividends that investors are getting are growing. And I'm trying to buy it at reasonable valuation. So we're sort of cushioned to the downside a little bit. So if I can get the lower volatility in the fund, investors tend to hold their funds longer. They tend to, and over time, will benefit more. Invest in advisors that are advising some of our clients tend to be more comfortable with this strategy. You can sleep at night. I can sleep at night. And then I just look for a good combination of income and growth. And if I can find like a good quality income, I sort of think of the algorithm for the fund is, what do you get? Like, how much income can you get if it's a 4% yield, if a company's growing 8 or 10%, and think about a 14% total return. And then I try to buy it at a reasonable price so we're not losing too much on valuation. If you put that all over time, get a really good return, a little bit lower volatility, and you tend to hold your fund. And 10 years later, you look back and say, I've done really well.
You talked a bit about getting lower volatility in your funds, but in today's market, I guess from an investor's perspective, a lot of scary headlines out there right now, experiencing, quite a bit of market volatility with geopolitical tensions rising in the Middle East, inflation still there. How do you sort of mix those concerns into your fund, and how does it stack up against this evolving market?
Yeah. What I would say for investors is, listen, there are always scary things going on in the market. I've been in the business a long time now. I've gone through a dot-com bubble. I've gone through the great financial crisis. China slowing down hard, oil coming up and down, COVID. And guess what? Like 20 some odd years later, the market is higher. People have made a lot of money. These were all sort of buying opportunities for people. So what I look for in volatility, when there's volatility in the market, one, I have companies that may not be subject to as much volatility, and I just find the fundamentals are good. We talk to our analysts. Does Iran have any impact on the particular earnings of the company? The answer, not much. The fundamentals are good. They're going to be good for the long term. If the companies come down a little bit because of overall market sentiment, I say, listen, this is probably a really good time to actually add more of these companies. There will also be companies that sort of benefit. Like you look at Canada, we're probably this higher oil prices is actually for GDP in Canada, or just growth of the country, is actually a net positive because we're such a large oil producers. Very few countries in the world that actually can say that. You got to be a little bit careful about what happens to the consumer if oil prices stay not higher, and think about sort of who's subject to risk there. And there's other things in the market going on just in Iran, but AI winners and losers, and there's a lot of things going on. But the nice thing is we have such a broad depth of research and people covering companies we're calling. If there's volatility, we pick up the phone, we call the CEOs, we say, listen, what's going on? We get a full update on what's going on, where they're exposed, and we can figure out what's the impact on earnings, and is this something we should be adding to, or is this something we should be reducing in the portfolio? And just, we're on it every day. We've got a large, scope of coverage, and over time, sometimes higher volatility actually works to our advantage, and we can go in and find companies we think 2 years from now, 3 years from now, they're going to be a lot higher.
You talked a little bit there about the breadth and depth of our research team, and having boots on the ground and contacting those CEOs because we have that relationship with them. What else gives Fidelity that edge when it comes to this type of market? You've talked a lot about that in the past.
Yeah, well, I think it's a combination of a system we've been running for 20, 30 years. We can go in every time our analyst meets with a company, there's a note in the system. There's an income statement, there's a balance sheet, there's a cash flow statement updated, there's an investment thesis on the company, why we own it, why we shouldn't own it, what's changing with the company, where we are versus what other people sort of think where the advantage we think on our research is. We also have this sort of a wonderful sort of infrastructure of people. Most of our PMs here at Fidelity, including myself, we're all analysts. So we've gone through, and we're all here 25 years later. We all still talk. We're all still collaborative. We all sit in the same space. And it's just a system. So the analysts are always coming to talk with the PMs talking with the analysts, going back and finding ideas. And the PMs are always talking amongst themselves and where the best opportunities are. And it's just the sort of the depth of institutional knowledge that's built up in this place over a long period of time. If you combine that with the access to management, technology has gotten better over the years, and just the amount of calls we're doing, the amount of conferences we're going to, and the amount of interactions and the institutional knowledge that's built up over years, we feel we really do have an advantage over time that should benefit our fund holders.
Yeah, definitely an incredible ecosystem here at Fidelity. Now let's go back to the investment landscape, Don. I feel like in 2025, it was all about tariffs. And in some way, shape, and form, we've been able to sort of quell those fears and hold back some of those tailwinds from the tariffs. 2026 seems like the big theme is now geopolitics and how that's affecting the markets. What are you looking for specifically in 2026? What is exciting you at this point in time?
Sure. Yeah, I think it's really interesting. Like tariffs fall into the same categories. Everyone got really nervous about tariffs. An awful thing. Oh my gosh! I said, get rid of all my stocks. And a year later, the market's higher and things have sort of settled down a little bit. This year started out with sort of a couple of really nice things going through the market. So it was a combination of sort of monetary policy, and that's sort of where interest rates are set. Generally, central banks we're not raising interest rates anymore. And so in some cases, we're cutting a little bit. That was sort of a tail end. In Canada and in a number of countries around the world, we had fiscal policy, which is basically government spending. In Canada, we're starting to spend on infrastructure. We're starting to say, hey, maybe we rely less on other countries in the world and actually sort of, spend and become a little more sort of business friendly ourselves and sort of spend on infrastructure. That's great. Earnings have actually been relatively good in the market. So it's like companies are earning more money, and generally you earn more money, your stock price is going up. We've had a little hiccup thrown in with geopolitical risk. And I'd say geopolitical risk, and then there's been a lot on sort of the AI front. The geopolitical risk, as I mentioned, Canada is actually somewhat of a net beneficiary in terms of most of the rest of the countries because we've got stable sort of resources in the ground that are accessible, that are not subject to this. Great, you probably over time realize that now part of the rest of the world may not be as stable. The resources in the ground that we have in Canada are probably become even more valuable. And people start paying a little bit of a premium. You can start seeing that in the market. So that becomes sort of a nice hedge in the market. You go and look at other things in the market that may not be impacted by higher oil prices as much. You look at really good companies that are in sectors that are just benefiting from things that sort of are outside of that. So to take a look, like the AI theme has been really interesting. I'm not sure who's going to win there. There's a lot of money being spent. It's very capital intensive, but there's a lot for what I do, there's a lot of companies that will do the infrastructure behind that. So like boring old utilities have the demand for electricity is the highest it's been in multi-decades. And they just keep seeing their demand go up for the electricity they produce. Their capital expenditures go up, which is actually great in the utility world. It's great for sort of pipelines. Anyone that's producing shipping natural gas. That's how you're going to power all this AI stuff. The idea of onshoring. The world is went global is now becoming a little more regional, a little more insular. Money's comes back into the country. You find sort of like industrial applications that are being brought back in.
So lots of opportunities within the AI theme.
There's tons, but it doesn't have to be AI and companies trading at 100 times earnings.
Right.
5% dividend companies that been really boring for many years, but now they've got this new leg of growth, which is great, but it's sort of underappreciated. Everyone wants to play sort of the sexy theme, who can grow the fastest. Well, you know what? There's an upstep in growth in a lot of these companies. The dividend yields are really good, and the volatility is a lot lower. So there's a way to play a lot of things in the dividend world these days, which is really exciting. I really like the theme of like people getting old. It's finally sort of kicking in. The baby boomers are finally getting to an age category where a lot of them are hitting 80 years old. So like seniors care and home care and a lot of different like infrastructure stuff that deals with seniors, incredibly interesting because there hasn't been necessarily a lot of supply brought in because of COVID. And to deal with this particular segment of the market that's just so massive. And I think that's a really interesting thing for the next year. And Iran has nothing to do with it. The U.S. conflict has nothing to do with that. So there's lots of opportunities out there, and you just got to keep care the geopolitical. You know the geopoliticals, and make sure you have some hedge in your portfolio just in case things go one way or another. But just like all this other stuff, this too shall pass, and you don't want to get overly emotional based on something that may last months. It may be over in the next week. Who knows?
Talking about overly emotional and possibly mixing your emotions with your investments. We talk a lot about on the show about the value of advice and the importance of connecting with your financial advisor when things get rough and revisiting your time horizon and your investment journey. You've talked about this too, Don, the importance of it. Why does it matter?
I think it matters. It matters a lot. I mean, I have a lot of friends that even graduated from sort of a commerce degree. They don't do this. They do a lot of other wonderful things. They don't have time to pick their own stocks, to manage pick their own funds, put together and it's not even that. It's putting together a plan for the rest of your life.
Right.
It's, when are my kids going to school? How am I paying for retirement? Where is my risk tolerance? And that's a really different. One of the wonderful things that investment advisors can do for you is figure out, okay, where do you fit on the risk tolerance? Are you okay with the volatility, or it's too much for you? Put you in get you an appropriate portfolio for your risk tolerance that you can hold over time and continue to hold for the next 5, 10, 20 years, and meet your goals without the necessary stress of trying to do it all yourself. There is real value to advice. We're a portion of that. But the investment advisor does so much more than just pick stocks. It's a whole sort of a holistic sort of view on where you are in some cases 20 or 30 years.
Don, before we let you go, one last message to investors on how a dividend strategy could fit in their portfolio right now.
Yeah. Listen, I've been doing this for a long time. I'm a big proponent of the idea of sort of good dividend portfolio for the long run is a great way to generate terrific capital appreciation over the long run, generate a wonderful income stream that actually grows. And I mentioned that different than bonds, different than GICs. So it's income that's growing with capital appreciation over time, with a little less volatility. That it mentioned that there's some tax benefits to it. And you've got a little volatility, you're still bringing in that income. So I think for my view, it's a strategy for the long term. It's a strategy for most people. And it's just a wonderful combination of growth and income. And you don't do anything for it. It just comes in, appreciates every year. And then over a long period of time, you will see a tremendous capital appreciation on your portfolio as well. So just a wonderful combination of income and growth.
Don, always a pleasure to talk to you. Thank you so much for being here and sharing your insights. Really appreciate it.
Thank you, Emily.
Thank you for watching The Upside. For more investor content, be sure to subscribe to Fidelity Canada's YouTube channel or sign up for our Upside newsletter to register for upcoming episodes. Thanks again for watching, and we'll see you next time on The Upside.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.